The E-mini has been sideways for 8 days. Today's the 9th day, and alternating up and down on the daily chart. The bulls are hoping that this is the low, 2 big legs down on the daily chart, 1 pullback 2, but not a good buy signal bar here, not a good buy signal bar here, and not a good buy signal bar here. And I think that makes it basically a 50-50 bet. I do think we're going to get up here, maybe to the high by the end of the year. The market's deciding if it has finished going down yet. And I think there's at least a 50% chance we're going to get one more new low. How far down do we go? Weekly chart. Here's the pre-pandemic high, around 3,300. I do not think we'll get that far. Back in January, I created a video and I said that I thought the low of the year would be between 3,700 and 3,900, which is where we are now. But the sell-off has been strong enough to make me think that we may have to go lower. We had 7 consecutive weeks, bear weeks, on the weekly chart, and that makes it likely on the weekly chart that we're going to test low, if not go a little bit lower. If we go a little bit lower and reverse up, then we'd have a wedge, 1, 2, or 3. I think it's unlikely. When you look at the weekly chart, I think it's unlikely that this is the bottom. Weekly chart, it looks like we can get one more leg down. Daily chart, you have a better case at the bottom, but we've had a lot of strong rallies similar to what we had here, and they all failed. We had that, and this, and that, and right now the market's deciding. Are we going to go up here, which is, I guess I think we're going here, and then decide. This is a triple top with 3 good bull bars, and we reverse down about a measured move. So I suspect we're going to go up there and then decide whether to continue up here or form a double top and make a new low. So when I look at this, this is a good enough bull surprise for second leg up, and we have a very obvious magnet here. So on the daily chart, it looks like we probably will go up here and then decide whether to go back down or all the way up there. We have an inflation report, I think, tomorrow, and the market might be waiting for that to decide on the direction of the breakout. Sideways for now 9 days. I always make the point that bull channels are bear flags because 75% of the time you break below, and bear channels are bull flags because 75% of the time you break out above. Bull channel broke up below. Bull channel broke up below. Bear channel broke out above. Bear channel broke out above. And then bull, and then bear breakout. Bear channel broke out above. Bear channel broke out above. Bull channel broke below. We sold off strongly yesterday. Trending trading range day. We had a triangle, a bull breakout, then a bear breakout, and then another trading range. Bulls are hoping to get a reversal up. A trading range late in a bull trend is often the final bull flag, so if you break below, the market tends to get back there. This is also a wedge, 1, 2, and now 3. So this is similar to what we had here, a bear channel and a bull bar, and we rallied. Bear channel and a bull bar, and the bulls hope that we rally, but they really need bar 1 to close near as high to attract many buyers. If there's a fairly prominent tail, you'll get fewer traders buying above 1. Trying to close the gap, just close the gap. Globex low, we broke below the Globex low. Bulls would like to get up to the Globex high, but this is a pretty strong sell-off. It's unlikely we'll go straight up there. More likely this is a minor reversal, and that will stall before we go very high up. And the bulls will probably need some kind of a double bottom. 5-minute chart, possible low of the day, but not an ideal buy. Two problems with it. One is a fairly tight bear channel, and then a big bar. Big bar means big risk. You're risking 20 points, $1,000 per E-mini, which is a lot. And so big risk. And look at where we are. We are right below important support. Important resistance. This is closed in the moving average. And therefore the profit potential here is not all that good. So you have lower probability and bigger risk. That will reduce the number of bulls buying above 1. It's a possible low of the day. I did not buy it. If I were not talking, would I have bought it? I probably would not, because whenever you see a big signal bar and you're right below resistance, there's often sellers above. Yesterday, bar 13 outside up, right below the prior high. That's not good. I don't like to see big buy signal bars forcing you to buy right below resistance, like the top of a tight trading range, like yesterday, or 60-minute moving average from the moving average. The bears are hoping one is a bull trap, like 4 yesterday, and they want a bear trend. But we're at the bottom of now a 9-day trading range, and we have a very big bull bar, bar 1, that will reduce the number of sellers below 1. So here we have a situation where we have a big bull bar 1 and nobody bought above it. And now we have a low 1 and a bear channel, but a lot of traders are not going to sell below 2 because it's following a very big bull bar. So if traders do not want to buy at the top and do not want to sell near the bottom, most likely trading range open like yesterday. Right now it's still on the buy above 1, stop below 1. Can you get out below 2? I think if you bought above 1, you had to know a lot of bulls would not buy above 1, but a lot would buy a 50% pullback. And we're a little bit more than 50% pullback right now. So it does not make sense to exit longs here, because more bulls are likely to buy here than here. So it doesn't make sense. If you bought above 1, you had to assume we were going to have a 50% pullback. And therefore, it does not make sense to exit at a 50% pullback when you know more bulls will buy the 50% pullback than will buy above 1. Selling below 2, the opposite problem of 1. You're at support, the bottom of a 9-day trading range, and it's following a very big bull bar, so it's a low probability short. 2 is a very big bar, so the risk is big. So you got big risk and low probability. And there has to be a reason to take a trade. Either you have good risk reward, or you have high probability. If you have neither, it's usually better. You have a better chance of making money by doing the opposite. So whenever a trade has bad risk reward and bad probability, you're probably in a limit order market. More traders will trade with limit orders than with stop orders. So above 1, low probability and bad risk reward. Therefore, probably more traders selling with limit orders at the 1 high than buying with stop orders. And the opposite is true with 2. Big bar, big risk, but you're selling at support and after a big bull bar. So you get big bar, big risk, so bad risk reward, and low probability. You're selling at a bad location after a big bull bar. And therefore, it's not a good stop order sell below 1. It's below 2. There probably are more buyers below 2 and below 1 than sellers. So better to wait. It's still on the buy above 1 as long as we stay above the 1 low. So some bulls will buy the close of 2 and the 2 low, put a stop below 1, looking for at least a scalp up. And as far as going short, this is a possible high of the day, but I would like to see at least a couple good bear bars. If I'm selling far below the moving average, I want the bars to be far above average bearishness. And right now we have two bars. One of them is a very big bull bar closing near its high. That is not far above average bearishness. And therefore, I don't want to sell below two. I'll need 2 or 3 or 4 consecutive bear bars to undo the bullishness of one. So if I'm going to be selling far below the moving average, I need to see several bear bars to erase the residual effect of one. As a general rule, if we have consecutive bear bars, one being big and closing near its low, it's a sell to close market. So if 3 closes near its low, we'll have consecutive big bear bars closing near their lows, and it would be sell to close. But risk is big. So if you trade, I would trade very small. And in general, I think it's good to have 2 position sizes. Your normal size when bars are normal size, and then a smaller size. And I think the smaller size should be very small, maybe 20% of your usual size. So if you normally trade 1 E-mini, 20% size would be 2 micro E-minis. If you normally trade 500 spider contracts, 20% would be 100 spider contracts. What happens if 3 is a bear bar, but a conspicuous tail below? I would not take the short. The bulls are trying to get a second reversal up from below yesterday's low, but they have a big bear bar too. And bulls will only buy above 3 if it's a pretty good size bull bar. And if it's not a pretty good size bull bar, they'll wait. Remember I said, because of location and the size of the bars, I think we have an increased chance of a trading range open. So now we have consecutive bear bars, one big and closing near its low. Normally that's sell to close, but in part it depends on context. If the 2 bars were reversed, if 2 had the tail and 3 was the big bear bar closing near its low, I would sell. That would mean the momentum is to the downside is picking up, and it lasted 10 minutes. So, but that's not what we have. 3 has a conspicuous tail, a close in the middle third, and a close above the 1 low. So that's not bearish enough, especially after a big bull bar 1, to be selling this far below the average price. If I'm selling that far below the average price, I want the bars to be far above average bearishness. Is it sell to close? Yes. But I'm not going to take it. I'm going to wait. I talked about the bottom of the trading range. There's a 60-minute chart. Right now, this is the bottom of the range. This is now a 9-day tight trading range. And last week's low is the bottom of the range. Back to a 5-minute chart. On the weekly chart, last week is a low 1 sell signal bar. We have a bear trend. We have lower highs and lower lows, and a bounce last week. And last week is a bear bar. So for the bears, it's a low 1 sell signal bar, but it has a tail, conspicuous tail, a small body. That lowers the probability. It follows a big bull bar. That lowers the probability. And it follows a sell climax. That lowers the probability. So the bears are trying to get below last week's low. And I guess they probably will get below last week's low today or tomorrow. But there may be more buyers than sellers below last week's low. Now, can you buy above 4, a second reversal up? I think bulls will buy above 4, second reversal up, if they get a decent size bull bar. When things are unclear, a lot of traders either wait until they become clear or they trade small and then they add to their position depending on what they get. So some bears who sold below 2, stop above 2, traded small, and they'll sell more above the bear bar 3, or they'll sell more 5 or 10 points above their first entry, the too low. Some bulls have bought above 1, knew we may get one more leg down. They used a wide stop far below 1, and they bought more at the 1 low, or 5 or 10 points below the 1 high. So you got limit order traders trading here, increasing the chances of a trading range open. For the bulls, it's a high 2. It's a second reversal up from below yesterday's low, but not a lot of bulls are going to buy above 3 consecutive bear bars. And 4 right now is a big bull bar, similar to 1. A lot of bulls are not going to buy above 4 either, because it's similar to 1. A big bar, so the risk is big, and the location is not great on the 5-minute chart. It's just below the moving average resistance, and we have consecutive big bear bars. So this is more likely going to continue as a limit order market. A big bull bar 1, you sell. A big bear bar 2, you buy. Reversing up above 3, you sell. So most traders should wait. New low 3, so the bears see 5 as a pullback, a low 1 sell. After the first bar, we reverse down and we reverse up. For me, that's the minimum needed to conclude that we have a trading range open. And sometimes it'll just keep going up and it'll become a bull trend from the open, or it'll continue down and become a bear trend from the open. But right now, it looks like there are problems with stop entry setups. We have consecutive bear bars, but tail on the bottom of 3, and you might get consecutive bull bars here. But a lot of bulls would like to see a breakout above the moving average. Not just a tick or two above, but far above. How high up can we go? Well, the market stalled yesterday at this price. So, and then we have the 60-minute moving average just above. So if we go up, I suspect that we'll go sideways somewhere in this area. Remember I said 2, 3 consecutive bear bars, one being big and closing near its low, but the second one had a tail. I said more traders would have sold if 3 closed near its low. Now we have 2 bull bars, 4, 5, with at least one having a big body. Do you buy the close of 5 if it closes near its high? That would be a more persuasive buy than the sell at the 3 close or the 3 low. But their stop is far below. The stop is 30 points below. So if you do buy, you have to trade very small. If the tail is very big, 3, 4, 5 points, better to wait. Can you sell the close of 5? I would not. It's a second reversal up from above yesterday's low, and it looks like it's going to be a pretty big bull bar closing near its high. 3 is a bad-looking 5 signal bar. So what does that mean? That means we're probably going to come down and test the 3 high at some point today. Obviously, if we get a third big bull bar closing above 42 and above the 60-minute moving average, then today will probably end up being a big bull day. Traders are paying attention to how big the tail on the top of 5 will be. The bigger it is, the fewer bulls will buy the close. Can you sell? I would not sell. I think you're either long or you're looking to buy. But if you do buy, okay, fairly conspicuous tail, but close above the moving average. Not a close above yesterday's close. So it's not as bullish as it could be, but it's probably a buy the close market. However, the stop is below 3, and so you're risking 30 points. So if you take the trade, you have to trade small. Whenever that's the case, a lot of traders wait and try to buy a 50% pullback, which would be around the 3 high. So here's a 50% pullback. 3 high, a bad buy signal bar. So some bears sold the 3 high, sold more 10 points higher, sold more 20 points higher, expecting it to come back to the 3 high. But they're very disappointed by the bullishness of 4 or 5. So the bears will buy back their shorts. And the bulls know that, so the bulls will also buy around the 3 high. And they'll buy around the 50% pullback. Let's say you're looking to buy, but you don't want to buy here because the risk is too big. What about selling below 6 and then looking to buy around a 50% pullback? I think that's a common thing that beginners do. And I think it's a bad habit. If you're looking to buy, it's better to only look to buy and not sell down to your buy zone. If you're looking to buy, you think the market's going higher, and therefore there might be more buyers than sellers below 6. So I would not sell below 6. Now, when you're looking to buy, only buy. Don't go trying to get 2 trades out of it. Oh, I'll sell, and then when it gets down to my buy price, I'll take profits on my short and then go long. I think that's a losing strategy. Buy the closed bulls. Are they really going to risk all the way to below 3? Unfortunately, in this particular instance, they probably should risk all the way below 3. What happens if 6 is a bear bar closing there, it's low? I'd get out below 6. But if it's a bear bar closing in the middle, I think you have to risk more because there's a magnet at the 3 high and the 50% pullback. So even if it's not a good sell signal bar, the market still might get drawn down to yesterday's low, the 3 high, a 50% pullback. Always buy the closed bull trend, an inside bar, so it's a high one buy, but it has the same problem that the bulls who bought the close of 5 have. Big risk. Can you get out 5 points below 6? You know, I would not, because that gets you down into the buy zone. You'll be selling out of longs at a price where other bulls are looking to buy. If 7 is a bear bar closing there, it's low. Then we have a micro double top, up on 5, down on 5, up on 6, down on 7. But for me, it's still not good enough to go short. A lot of bulls are waiting to see if we test the 3 high and reverse up. Some of the bulls will buy with a limit order at the 3 high. Some will buy with a limit order at a 50% retracement. And now a 50% retracement is here. And others will wait for it to get down here. And then they'll wait to see if we get a bull bar, a higher or low major trend reversal. And then they'll buy above the bull bar. That's what most traders should do. For the bears, a higher high double top, bar 2, but 3 big bull bars. Probably more buyers than sellers at the 6 low, so I would not sell below 6. Is it okay to buy the 6 low? Yeah, but you still have the problem of a stop down here. If 7 closes below its midpoint, you can always exit below 7. The bulls are trying to prevent it from dropping down to the 3 high. They're trying to hold it above the moving average. And the bears are selling, expecting it to get down to the 3 high because that's what it normally does when you have a bad buy signal bar. The bulls who bought above 6 are thinking, darn, what do I do now? I did not buy above 6. I did not buy at all. Had I bought, I would exit below 7 because we might get down to the 3 high. We might get it lower. I would exit below 7 and look to buy again above a bull bar closing above its high. The bulls are going to try to keep it above the moving average. So 8 might end up being a bull bar. However, there are 2 fairly reliable magnets below. Well, 3. Yesterday's low, the 3 high, a bad buy signal bar high, and then a 50% retracement. So I think we're probably going to get down to at least 1 tick below that 50% retracement. And I think there'll be limit order bulls buying there and buying more lower. There'll be limit order bulls buying at the 3 high. And there are stop order bulls who are looking for a bull bar closing near its high, maybe 8, maybe 9, and they'll look to buy. And for the bears, a good reversal up 1, good reversal up 4, 5, 6. Most bears are not going to be shorting below 7. What happens if we get 2 or 3 bear bars? You'll start to get bears willing to sell, but I think the math is bad. 2 pretty good reversals up from the bottom of a 9-day trading range. I think it's really natural to focus on the current bar. So some bulls bought above 1 because it's a big bull bar, or they bought the close of 2 or above 6 because it's a big series of bull bars. They sell below 2 because it's a big bear bar. They sell below 7 because it's a big bear bar. And I think you have to look at more than just the current bar. You have to look at the context. And by the context, I mean all the bars to the left. If you're looking to short, you want a bar that looks like 7. But is the context good enough for the short? I think it's a lower probability short. And 1, a very good looking bull bar, but is the context good enough to buy? Fairly conspicuous tail and just below the moving average, so not good context to buy. 50% retracement, so there will be bulls with limit orders buying 50% retracement. Other bulls will buy with a limit order, 3 high. And most bulls should be looking to buy with a stop above a bull bar, maybe bar 9, maybe bar 10. For the bears, this is a short, but I think most of them will be getting out around the 3 high and the 50% retracement. However, if 8 closes on its low, the bears will hold short. They'll take a chance that we'll get the new low in a big trend day. Consecutive big bear bars, does it sell to close? I would not. I'm right in the buy zone. So the bears who did sell the 3 high will buy back shorts here. They sold the 3 high, they sold more 10 points higher, 20 points higher, and they buy. So you got bears buying at the 3 high. The bulls know bears will do that. So what are the bulls doing? The bulls are buying. So do you want to be selling below 8? I would not. We're at a price where there will be buyers. Very good looking bear bars 7, 8. Possible high of the day. But I'm not willing to sell here. I think we have a trading range open. We've had strong moves up on 1 and then up to 6. Strong moves down 3 and 8. And we're getting reversals. So do I want to bet that this leg down is going to be different from the other 3 legs today? I'm not willing to do it. Testing the Globex high, testing the 3 high. And the bulls will need a very strong bull bar 9 to undo the bearishness of 7, 8. Can you sell on a stop below 3, the new low of the day, double top 2? I would not. It's probably a trading range open, and I don't want to sell low. And I don't want to buy high. I don't want to buy above 6, and I don't want to sell here. So right now I'm stuck on the sidelines. What happens if we get 4, 5, 6 bear bars, all closing on their lows and breaking far below 3 and far below the trading range? I will sell lower. Remember I said the weekly chart had a bear bar last week, and it's a low one sell signal bar. And I said, I think we'll probably trade below last week's low either today or tomorrow. I still think that's true, but it's a weak sell setup, so there might be more buyers than sellers below last week's low. $15-minute chart, 5-minute chart. There's last week's low. Bulls want a higher low major trend reversal, but they'll need a very good looking bull bar to buy after those two big bear bars. What do the bears do if they're still short? It's the opposite of 6-7, right? If you're short and you get a bull bar closing above its midpoint, I'd get out of shorts instead of relying on a stop above 7. That's too much to risk. Just like the bulls who bought above 6, their ideal stop is below 3, but that's too much to risk. And that's why I said, if you're long, get out below 7. Because if it's a trading range, we could come all the way down to the bottom, and that means your risk is very big, and you should not be taking trades where the risk is very big. Better to get out early. You can see the buyers, right, around the 3 high. For the bulls, a higher low double bottom, higher low major trend reversal, but a bear body and 2 very big bear bars. Probably always in short right now. So I would not get long above 9. Is it okay to be long? Yeah, remember I said some bulls would buy a 50% pullback, some bulls would buy the 3 high, stop below 3. So I think it's okay to be long. It's okay to be short, but I would get out maybe 5 points above any bar, bar 9. I'd get out 1 tick above a bull bar closing near its high. Everybody is taking quick profits, and we're getting a lot of reversals. You get out 1 tick above a bull bar closing near its high. Everybody is taking quick profits, and we're getting a lot of reversals. Most traders better off waiting here. This is a scalper's market, and the legs are big, so the risk is big. Higher low double bottom, higher low major trend reversal, but 3 bear bars in a limit order market, so might be more sellers than buyers above 9. Because it's a possible higher low major trend reversal, some bears who want to sell will not sell at the 9 high, but they will sell with a limit order 5 points above or 10 points above. Reversing every 2 or 3 bars. This is a scalper's market, and we're not getting good signals. There's a problem with buying above 1, above 3, above 9, a problem selling below 2, below 6, below 7. So it's more a fast money scalper's market, limit order market. Sell anything bullish, like sell above 9 or sell 5 or 10 points above 9, and buy anything bearish. Traders are betting against trends. They're betting in favor of reversals. Limit order bears, as I said, I would not sell the 9 high, but I think it's okay to sell with limit orders, 5 points above, 10 points above. And those bears are scalpers. They're not expecting a big bear trend, but they're trying to make a scalp. They sell 5 or 10 points above 9, and they place limit orders to get out at the 9 high. So there are buyers at the 9 high. Why did the 10 high stop where it stopped? Because it was a reasonable swing short below 7. The market is testing the entry price. The market often does that. They want to see if bears will sell again where they sold earlier, below 7. And some did. We have that tail on the bottom of 10, at the top of 10. What about the bears who sold the 9 high? It has not come back below the 9 high. Their stop is above 7, and they'll sell more higher. So they'll sell 5 points, 10 points above 9, betting that will come down below the 9 high, which we probably will. For the bears, they're hoping 7 is the high of the day, 10 is a low one, but it's a bull bar in the bottom half of a trading range open. So probably buyers not far below 10, not a good stop entry market. Just like sellers above 9, not a good stop entry market. Right now we're in the middle of a trading range open, and that's usually a bad location to do anything. What about selling below 11 if it's a bear bar closing near its low? Another failure at the moving average, like 2, like 7. That would be a third reversal down, a head and shoulders top bear flag, left shoulder 2, head 7. In general, if it's a trading range market or any kind of trading range, entering in the middle is usually a low probability bet. So buying above 11, selling below 11, probably better to wait. I've been saying wait all day, and I think that is the best choice. You don't want to be selling 2 bear bars at bar 3. You don't want to be buying 2 bull bars bar 5. You don't want to be selling 2 bear bars 9. More traders are doing the opposite. When it looks bearish, they buy. You don't want to be selling where the institutions are buying. When it looks bullish, they sell. And you don't want to be caught buying at the top where the institutions are selling. Remember, I always think of the market as either a limit order market or a stop order market. Stop order market means trends. Traders are expecting the market to continue. So they'll buy with stops or sell with stops, betting on a bull trend or a bear trend. Limit order market means you expect reversals. And in general, you should assume that half the time the limit order traders will be right, and half the time the stop order traders will be right. And you should be a stop order trader, which means a swing trader. And if the market is reversing, you're better off waiting. You don't want to be taking swing trades in a trading range. So you just wait until you get a reasonable setup or a convincing breakout. Limit order traders, they love this kind of an environment, right? They're betting against trends. Anything bullish they sell, anything bearish they buy. We're getting near the end of the first hour. Traders are deciding what the first 60-minute bar will look like. This is the 60-minute chart. And we're still in a trading range for 9 days. The bears are hoping we break below and fall for a measured move down. And the bulls are hoping that we break above and go up for a measured move. Because the weekly chart had a very strong sell-off, and last week is a low one, and it's a bear bar, I think we have to go below last week's low at some point this week. That means today or tomorrow. But it's a sell climax, and you expect a couple legs up. And we had one leg up 2 weeks ago. If we go below last week's low, I think we'll probably get a higher low and a second leg sideways 2 up. So there probably are buyers not far below last week's low. The bulls are hoping higher low major trend reversal, and that 10 is the start of the bull trend. So 11 is a high one buy signal bar. The bears are hoping 10 is a pullback in the bear trend, 7, 8, and 11 is therefore a low one sell signal bar. But you're in the middle of a trading range open, and it's a doji bar, a very neutral bar. So probably sellers not far above, buyers not far below, and most traders should wait. Right now, the market's deciding how the first 60-minute bar will look. And look where we are. Okay, here's the middle of the 60-minute range. We're right in the middle of the range, and I suspect that we're going to close very close to the middle of the range, maybe slightly below, maybe slightly above. 4 minutes remaining in the first hour, and we've had 3 moves up and 2 moves down, and we're right in the middle. Breakout mode. Traders have decided, like yesterday. Yesterday we had a trading range open, we had a triangle, we had a bull breakout that failed, and it became a lower high major trend reversal. We then had a bear breakout, a second leg down, but 4 bear bars, minor reversal. And we had a wedge, but a bad buy signal bar. And then we broke below the wedge and reversed up. Traders bought there. So you could either look at this as a wedge, 40, 50, 62, that failed, and then we reverse up from below the bottom of the wedge. Or you can say these 4 bear bars started the count over again. So this is leg 1, leg 2, and leg 3. So some computers will see this as a wedge starting at 50. Others will see the wedge as 62 and 68 as a failed breakout below the wedge. Does it matter if we close 1 or 2 ticks above or below the midpoint of the hour? Not really. It's still a close around the midpoint of the hour. If it closes a tick or 2 below the midpoint, the bears can claim they won the hour, that they owned the bar, but it's really neutral. So far, II, consecutive inside bars. What happens if 12 is an inside bar closing near its low? It'll be a sell for a swing down, a low probability. It's in the middle of a trading range open. And what happens if it's a bull inside bar closing near its high? Same thing. So it's not a very reliable II pattern in the middle of a trading range open. You'd rather have an II at the top or at the bottom. When it's at the top, there are probably sellers above for a final flag and sellers below betting on a failed breakout and a reversal down. If you have an II at the bottom of a bear trend, there'll be buyers above betting on the sell climax and the reversal up, and there'll be buyers below betting the II will be the final flag. When you're in the middle of a trading range open, 50% chance there'll be sellers above and buyers below. Better to wait. Not an II, a bull bar closing near its high. We still are on, theoretically, the buy above 9, but I think this is not very good stop entry trading yet. Bulls hope 3 will remain the low of the day. Maybe slightly better than a 50-50 chance it will. And bears are hoping that this is going to be a higher high double top 10 and a failed breakout. Remember, there's still some bulls who bought above 6, stop below 3, and they bought more lower, maybe above 9. And then for the bears, they're hoping for another lower high. 74, lower high, and lower high here possibly. Better to be patient. Can the bulls get a big bull bar closing on its high? That will increase the number of bulls willing to buy closes. Can the bears get a bear bar closing near its low? That will increase the number of bears willing to sell below 13. A lower high, second leg down after 7, 8. You can see why I keep saying, be patient, be patient. This is not good for stop order traders yet. Can you sell below 13? You're in the middle of a trading range open. So the math is not very good. Limit order market. Anything bullish, they sell. Anything bearish, they buy. And they take quick profits. And you will not make a living as a trader doing that. if you become consistently profitable with swing trades, which is what you should be doing, you can add some limit order trades later on, but I would not start with the limit order trades. Too easy to make mistakes. Limit order trades later on, but I would not start with the limit order trades. Too easy to make mistakes. Yesterday, limit order market. What happens if you bought below 32 or below 35? At some point, you have to give up, and you probably would have a hard time figuring out how to do that. That's the problem with limit order trading. It's a high probability way to trade, but the occasional big loss erases all your gains. Occasionally, you'll get a successful breakout, and you'll be buying, and then you'll finally have to give up, and you'll end up with a big loss. In general, if you're limit order trading and you get a couple closes below the moving average, and one of the bars is big, like 35, closing near is low, I'd get out below the low of the bar. So if I bought the 32 low and got filled over here, and then I see a big bear bar closing in its low, especially a second bear bar closing, the second consecutive bear bar, I'd get out around the 36 close or below 36. And I probably would get short. Bulls, they're still on the buy above 12, stop below 12 or below 11. And for the bears, it's a low 1, but a big bar, so big risk. And you're selling in the middle of a trading range open, so low probability. Right now, we had a big move up, 4, 5, 6, big move down, 7, 8, 9, but we're above the 3 low. So I still think it's slightly more bullish than bearish, but not a good buy signal bar. 3, 9, 11. So I think the math is not very good for doing anything at the moment. If I had to be long or short, I'd be long, but I'm currently flat. I don't think the math is good enough yet. What about buying above 13? Taking a chance. It's a small pullback bull trend, charting 9. The more bull bars you get, the more bull bars closing on their highs, the more bull bars closing above the moving average, the more bulls will buy, taking a chance that it's an early small pullback bull trend. But if you do buy above 14, I would trade small and then look to add on as it goes up. For the bears, they want a lower high, but a bull bar closes above the moving average, closing near the high of the bar. I would not sell below 14. Most traders just patiently wait. I would feel more confident about buying if the bulls had a good buy signal bar, 3 or 9. And whenever you get a trend, a rally, a bull trend, and you're not getting good buy signal bars, the bull trend probably is not going to last very long. In a bull trend, you want to see a lot of bars closing near their highs, because every one that does is a sign that bulls bought into the close. And they would only do that if they were confident the market was going to go higher. So you want to see a lot of bull bars closing near their highs. And in a bear trend, the opposite. You want to see a lot of bear bars closing near their lows. 14, a lower high in a bear trend that began yesterday, but a bull bar and a 6-bar bull microchannel. So probably more buyers than sellers below 14. So not a very good sell. Does it sell the close yet? Well, look at 2 and look at 8. What do you think? Should you be selling the close of a big bear bar around this price, around in this general area? That's not been very good so far. Bear surprise 15, but middle of a trading range open, so better to wait. The goal is to make money, not to make a lot of trades. And if you have a lot of trading range trading like today, you're not going to get a lot of good stop entry trades or buy the close or sell the close trades. But we will get some, and it's better to just patiently wait for the good trades instead of taking the bad trades. You can be long, stop below 3, hoping for an upside breakout. You could be short, stop above 7 or above 13 and hope for a bear breakout. Or you could wait for the breakout and see what it looks like. If it looks strong, like yesterday, you go in the direction of the breakout. If it looks weak, you look for a reversal. Becoming increasingly bearish. 15, 16, closing near the lows of the bars and below the moving average. Bears 17, they're trying to get a close near the low of the bar and at or below the 11 low. Remember I said, I think we're going below last week's low, either today or tomorrow. So it's becoming increasingly likely that we're going to go there today. Can you buy the close of 17 and bet on a high 2, 9? I think if you're looking to buy, it's probably better to look for a stop order buy, maybe above 18 or 19. And for the bears, it's becoming sell the close. We've been having a hard time getting above the moving average. We've only had 3 closes above the moving average today out of 18 bars. If you sell the close of 17, stop theoretically above 13, or maybe 2 or 3 points above 17. Or if we get a bull bar 18, get out above the bull bar 18. The more 18 closes on its high, the more bulls will take a buy. More bulls will take a buy. It's a high 2, 9. It's a higher low double bottom 3. The bigger the tail on the top of 18, the more bulls will wait. Bears, I'd get out above a bull bar, closing above its midpoint, probably 18. And for the bulls, unless it's perfect, I would wait. Still in breakout mode, the bears are hoping that we will get a successful bear breakout. 3 consecutive bear bars. Only 3 bars with closes above the moving average today. That will reduce the number of bulls buying above 18. The bears will sell the close of 18, trying to prevent 19 from going above 18. They don't want the buy signal to trigger. So it's interesting math here. You could sell the close of 18 and put a stop above 18. And for the bulls, it's a high 2 with 9, a higher low double bottom 3, but a tail and 3 bear bars. So for me, that's not quite good enough to buy. Still on the short, below 15, sell the close 17. But really the math is not very good here. It's still unclear. There's still a reasonable bull argument. Most traders, I think, are better off flat. If I had to choose right now, long or short, I'd choose short, but exit above 18. Since it's a trading range open, you have to assume everybody's going to be disappointed, and therefore we probably will go above 18 and disappoint the bears. Remember, bears are selling the close of 18. If it goes above 18, a lot of bears will buy back shorts. and the bears do not want other bears buying back shorts, so they're selling 18, trying to prevent 19 from triggering the buy signal. New low of the day. Why are we not collapsing? Won't the bulls give up? No, it's the bottom of a trading range, so 50-50 bet, 50-50 chance the breakout will fall for about a measure move down, 50-50 chance there'll be buyers below, and we'll get a lower low double bottom. Right now, I think we're sell to close since probably 17, but the bears need to break far below the low of the day. Remember, last week's low is a magnet below because we have a low one on the weekly chart. It looks like this is probably going to get there today. Bears, I'd get out a tick above the bull bar, closing above its midpoint, 18. I'd get out 2 or 3 points above any bar. Market's deciding, is this a lower low double bottom and the low of the day, or is this going to be a successful breakout that leads to a measured move down? Micro double bottom 18.20. I'd get out of shorts above 20. Bears will sell the close like 18, but get out above 20. Risk is small. That means you probably get stopped out. That means we're probably going above 20. Whenever the risk is small, the probability is low. Remember, risk, reward, and probability are opposites. If one is high, the other is low. So if you sell the close of 20 and put a stop above 20, your risk is very small. And if you have very small risk, you have very good risk reward. That means you have very low probability of success, and you'll probably get stopped out. For the bulls, it's a higher low major trend reversal, a wedge 13.17, a high 2, 9, a lower low double bottom 3, but only a small bull doji and a fairly after 4 decent bear bars. So I'd get out of shorts. I think it's okay to buy, but I think it's not a very high probability buy yet. So I think it's okay to wait. I think it's okay to buy, but I think it's not a very high probability buy yet. So I think it's okay to wait. The bears, they want a low one below 21. They're hoping we continue down to below last week's low. Possible low of the day. For the bears, a low one and an 8-bar bear microchannel. A double top bear flag 18, but 2 bull bars and not quite to the moving average. So most bears are not going to sell below 21. Bulls that they bought above 20, theoretically they get out below 20. To me, it looks like we're going down to last week's low. Not a very good looking sell, but not a very good looking buy. I think it's better to be flat. I did not take the buy. Low one, but a tail and a reversal. That will lower the probability of bears selling below 22. I think we're still on the short, but I think it's hard to be short right now. And for the bulls, they're hoping 20 is the low of the day, but I think it's not a strong enough bottom after an 8-bar bear market channel. So I think best choice is wait. Second choice is sell below 22. And for the bulls, they could buy above 20, they could buy above 21. I think best choice, wait. You can sense the uncertainty. I think we have to go below last week's low. It's possible that we reverse up here, but we've been failing at the moving average all day. This is not yet a strong reversal. So I did not take the buy. I'm flat. pretty good breakout. The bulls need the market to close near the high of the bar and above the moving average. If they do, you'll get more bulls buying the close. Other bulls will wait to see if we get a second bull bar. Breakout, but tail, and still a possible lower high. You can call it a little triangle here in a breakout. It's good for the bulls, but they really need follow through. Can you buy and put a stop below 27, below 25? It's probably better to wait to see if we get a second bull bar. The bears want a bear bar like 7, hoping it's another bull trap and lower high in a bear channel. Big bear bar. It's a failed breakout. The bears are trying to get a breakout below. We've been failing at the moving average all day. It's still not very good trading, tight trading range here. It's still more bearish than bullish. We're failing to hold above the moving average. And we have a really important magnet below. So I still think this is where we're headed. So I did not buy above 29. I did not sell below 28. When the market's in a tight range like this, the math is not very good for doing anything. So I'm waiting. I think it's important that we're failing at the moving average. I still think we're going down. If you have a choice, long or short, I would choose to be short. Do I think we're going to get a big bear trend out of this? No, I think we'll probably go below last week's low. The past 9 days, if you look at the chart, we've been mostly sideways, and yesterday was mostly sideways. And here's a 15-minute chart. We've had a lot of sideways trading. We're at the bottom of the 9-day range. I think we're going below last week's low probably today. So long or short, I would choose short. Bears, I'd get out certainly above 31. I probably would get out above 33 or 32 because if this is the start of the move down, it should not turn back up. It should just work its way down. So I would either be short now or flat. Will it turn into a big bear trend day? I think there probably will be buyers not far below yesterday's low, but I think that's where the market's headed right now. So if you sell, you can always sell small and add on if it accelerates down. And I think there's nothing to buy. I think the bulls are unable to get above the average price repeatedly, and that usually will mean they'll give up and we'll get a downside breakout. The market's been having a hard time holding above the moving average. It's a trading range day, but it's also a bear channel. In a continuation of yesterday's bear trend, we got lower lows and lower highs. The bulls are hoping to get a reversal up here, a lower low, major trend reversal, a nested wedge. There's a bigger wedge, 320, and then a smaller wedge, 42.51. And I was going to buy above 60 if it closed on the high, but it did not. As I said, I think we're going below last week's low, either today or tomorrow. It looks like we might get there today. We have a couple big financial things coming up. We have the CPI tomorrow. I think it's tomorrow. And I think next Wednesday is an FOMC day. So both of those things can move the market. As I said on the daily chart, traders are trying to decide, is the low in, or will we get at least a second leg up, or is this a higher high double top, and will the bear trend resume? At the moment, it looks more likely that we'll get at least a small second leg up, maybe a wedge 1, 2, and 3. But we've been in a bear trend since the start of the year on the daily chart, and therefore, no one should be surprised if we go down and get a new low. I think there'll be buyers below this low. Traders bought below this low. They bought below that low. They bought below this low. And they bought below that low and below this low. And they'll buy below this low. If we break below this low, I suspect that we may get a very quick move down, a couple hundred points or so over the course of a couple of weeks. But I still think we're going to try to work higher in the second half of the year. The end of June tends to be bullish going into the 4th of July. And that means that there's often a sell-off in the middle of June, and we're entering the middle of June. Whenever you hear someone says the market tends to be bullish from, pick a day, June 26th to July 5th, that means it's not as bullish from June 25th or June 23rd or June 20th. So what they're saying is there's often a reversal up from a sell-off at the end of June. So that means in the middle of June, there's an increased chance of a dip. Bears that are still short from below 55. This is similar to yesterday. Was it yesterday or the day before? I'm not finding where I want to find right here. But a bull trap and then a new low. Pretty common late in the day to get traps here. Strong bull trend. We had a bear trap. To me, that's probably by the close and probably a bear trap and not the start of a bear trend. There's often a reversal attempt around 11 o'clock, 12 o'clock. And if the trend is strong, the reversal usually is brief and it fails and you get a new high. Some days are great for stop order trading, and those days are called trend days. And some days are great for limit order trading, and those days are called limit order days. And this is much more of a limit order day. There are a few little moves, brief moves, above 34. I ended up entering late and then selling either below 47 or on the close of 48. But even then, there's still not a lot of follow through. Selling below 55. Now, why do I think we're going below last week's low, the screen line? Because of the weekly chart. On the weekly chart, we had 7 consecutive bear bars. So the first reversal up will probably be minor. Last week was a bear bar, and therefore it's a low one sell signal bar. However, a sell climax typically leads to 2 legs up, and we've had 1 leg up, and therefore there probably are buyers below last week's low, and then we'll get a second leg sideways to up. Especially with a pretty good bull surprise bar, we'll probably get a second leg up. So yeah, I think we're going below last week's low. We're going to trigger the low one sell signal. I suspect there'll be buyers not too far below. Big bear bar. Bear was in short since 48. 54 is a trap, a test of the moving average. But not a very strong bear trend. Traders are not. It's more limit order trading. So bears would rather sell with limit orders above bars, like above 57. Or if you get a strong bull bar, instead of selling the 52 high, a lot of bulls will sell with limit orders 5 points higher, 10 points higher. The bears see this as a double top and a lower high in a bear trend. We're breaking below the neckline of this double top, and they'd like a measured move down. There's not much energy today, so I doubt we're going to get the measured move down. But it looks like we are going to go below last week's low to trigger the low one sell signal on the weekly chart. However, because the day does not have much energy and not much follow through, I think we are not going to collapse below last week's low. There might be buyers not too far below. By the way, today is rollover day. I still trade June today. June has much more volume. And tomorrow I will trade September. During about an hour ago, I had to adjust all of these lines. The rollover contract today is now September. It was June as of yesterday, but now it's September. So I had to adjust all of the lines. Let me just do something here. Okay, so on the June contract, the price is 40.76, and on the September contract, the price is 40.77. So what does that tell you? September contract is higher than the June contract. That tells you traders expect the price in September to be higher than it is right now. Remember, the E-mini is a futures contract, and it's predicting what the price will be when the contract expires. So the September contract expires in September, and right now the computers think that when it expires, it'll be right here, 40.76, which is higher than a point or two higher than the June contract. A month or two ago, I talked about how the June contract was below the March, and the September was below the June, and the December was below September. So when the market was selling off strongly earlier in the year, all the later contracts traded at lower prices. So traders were expecting the market to sell off all year, but that's not the case now. Now, September, the price of the September E-mini is above the price of the June E-mini. So that means traders think the market will be higher in September than it is right now. Just a little, just a point or so. So it's not as bearish. The E-mini is not as bearish as it was a couple months ago. Parabolic wedge 57.60, wedge 42.51, wedge 3.20, but a lot of bear bars in a tight channel. So bears, I get out of shorts above any bull bar, but for the bulls to get long, they would need, I think, a big bull bar closing near its high. A lot of times when the market gets near a significant support or resistance level, it'll reverse before it reaches that level. You know, I often use the example of outside down and outside up days. Very often the market will reverse up from just above yesterday's low. And sometimes the sell-off down to yesterday's low can be very strong. And yet the sell-off is simply a test of yesterday's low, and traders buy just above yesterday's low and prevent the market from going below yesterday's low. So I call it upside down almost. So here, a big sell-off, but it was simply a test of yesterday's low, and the market reversed up despite all these bear bars in the tight bear channel. Here we collapsed, and it was simply a sell vacuum test of yesterday's low, and traders thought it would hold above yesterday's low, and they bought. And all of this was simply a test of support, and the bulls were supportive. They bought, and the bears got scared and bought back their shorts. Huge collapse, could not get below yesterday's low. So it's possible, it's possible that we do not get below last week's low, but as I said, I think we have to go below last week's low. We had 7 consecutive bear bars on the weekly chart, which is very strongly bearish. And now we have a low one, and last week was a bear bar. I think traders want to see what's below last week's low. Is the bear trend going to resume, or are we going to get a second leg up after the big bull bar from 2 weeks ago? We're right down at last week's low. Actually, this low is 1 tick above last week's low. We did not get to last week's low. Bears, I would get out above 63 if it has a bull body. If it has a bear body, I'd still get out 2 or 3 points above 63. And for the bulls to buy above 63, they need it to be a decent looking bull bar, like 20. Remember, I think we're going below last week's low, so I think this is probably not going to be the low of the day. I think we have to go a little bit lower. Not a good buy signal bar. I would not get long above 63, but because of the location, very important support, this could be the low of the day. And therefore, I would get out maybe a couple points above 63 if you're short, just in case we get some crazy big bar like 3. You don't want to wait for a big bull bar closing up here and then get out 10 points higher. If you get out a couple points above 63 and then get a bear bar 64, 65, 66, you can always sell again. What do? Do you buy above a nested wedge, a double bottom, last week's low? Or do you sell above 3 bear bars, not a good buy signal bar? While I think there probably are going to be sellers somewhere above 63, the location is really good for the bulls, and therefore I would not sell above 63. If it were a really strong bear trend day, I'd be much more willing to sell this near the low and just in this close to important support. It's just not all that strongly bearish. And for the bulls, it's a 7-bar bear microchannel, 6-bar bear microchannel, and a very tight channel for about 10 bars. I'm not buying above 63. You can tell when it's difficult to get stop entry trades when there are big reversals, big bull bars that reverse, big bear bars reverse. The buy signal bars are coming in tight channels. The sell signal bars are coming in tight channels, or they're bull bars or doji bars like 44, 45. So when there's something wrong with everything, it's probably mostly a limit order market. So not very many good opportunities for stop entry traders. That's okay. Some days are very good for stop entry traders. Some are very good for limit order traders. And you should never worry. I remember 35 years ago thinking that, oh my gosh, we've had 5 trading range days in a row. Maybe we're never going to have a trend day again. Maybe it's going to remain trading range days. And it's not. The market is constantly going to probe every possible thing that it can do. So big bars, small bars, trading ranges, trends. It's going to do everything, constantly testing everything it can possibly test. And it's never going to continue to do any one thing for very long. Because if it did, all the computers would see what's going on and nobody would take the other side of the trade. So nobody's taking the other side of the trade. All of a sudden, the pattern that has worked for the past week is no longer going to work. So you should always expect the market to do as many changes as it possibly can do. Remember, what's the purpose of the market? It's to facilitate trading. Institutions got together and created markets to make it easier to trade. If they can bring a whole bunch of traders in, then the bid-ask spreads are much tighter. If you want to sell a house and you live in a town with only 2 houses, you're going to have to sell a house at a really low price because your neighbor already has a house. There's not much incentive for him to buy unless he can buy your house really cheaply. So a market brings together lots and lots of buyers and sellers, and you have a much better chance of getting filled at a fair price, an appropriate price. One of the consequences of markets facilitating trading is that markets behave in a way to make traders trade. Facilitate trading means, you get better fills, but it also means increases the volume. One of the consequences of having a market is it's going to behave in a way to maximize volume, maximize the number of trades, maximize the volume traded. And the tool it uses to make traders trade is pain. Okay, you sometimes hear the pain trade. The market is going to move in a way to create the most pain. So whenever you think, oh, that's such an obvious buy, and then it doesn't go up and it starts to go down, you're in a lot of pain and you're going to be forced to sell. So it's always going to be doing things that you think are unlikely and unreasonable because it's probing. It knows where people will be in pain, and it goes to those prices to force those people to behave, force those people to take trades. And the result is it has to constantly be doing different things. You know, if it's too predictable, and there won't be any pain, but there also will not be any trading. You know, there has to be a reason for someone to take the other side of your trade. So if you want to buy and the sellers just are not interested, you know, you're not going to be able to buy at the price you want. You'll have to pay a much higher price. So you'll have to incur some pain. For the bears, a low 164. We should get below yesterday's low, last week's low, the green line. But I'm not confident we're going to go a lot lower. For the bears, they have a double top, 13 and 44. So a double top here. And they're hoping we break below the neckline, which is the lowest price between the two tops. And then they want it to fall a measured move down to there. And with the day moving as little as it has, we're probably not going to get down there. So there probably are buyers not too far below last week's low. Can we get back to the open of the day? It's possible. Sometimes when you get a trading range day, it just kind of oscillates around the open all day. And sometimes the open ends up exactly in the middle of the day's range. If that were to happen today, the low would have to be right here. So a measured move from the high of the day to the open of the day is right there. And if we get there or to within a couple ticks above or below it and reverse, the market will probably try to get back to the open. So that's a common situation where you have a lot of trading range trading and it reaches the measured move based on the high to the open, and then it gets to the measured move and reverses. If it does that, it tells you that the open is important, right? If you get a reversal, it's reversing from some important price. The high of the day is always important, and if it's reversing at a measured move that involves the open of the day is important, and if it's important, it could be a magnet at the end of the day. So if we get a reversal up from around where we are, especially from that pink line just below, the target would be back to the open of the day. Okay, we just broke below last week's low. That was the minimum that I thought we would do either today or tomorrow. And that triggers a low one sell signal on the weekly chart, but it's not really a very good looking one. Weekly chart, this is what we have. When you look at that, you say, wow, I got to sell. That's a bear bar and a bear trend. Or do you look at that and say, I don't know. It's a pretty big bull bar. The bear bar has a small body, a prominent tail below. It's a weak sell signal bar. It's after a sell climax, so we might get a couple legs sideways to up. So you'd have to look at that and say, yeah, there might be more buyers than sellers below the low of that sell signal bar. So it's probably not going to attract a lot of sellers. We're near a measured move from the high of the day to the open of the day. I do not have this drawn in perfectly accurately, but it looks like it's fairly close to accurate. Here's the open, and there's the high, and here's the measured move. It's a high 2 with 63. On bears, I'd get out above a bull bar. I'd even get out above a doji because it's a high 2 at support in a day that's been mostly a trading range day. For bulls to buy, they'll want the bar to close on or near its high, like 29, 34, 20. If it looks like 9, you'll get fewer bulls willing to buy. They'll wait. A lot of bulls will wait to see if the next bar is a bull bar closing near its high. Now, why would the bulls buy if the moving average has been resistance all day? It's because the market is telling us the open of the day is important. right? The high of the day is important, low of the day is important. Here, the low of the day is almost an exact measured move from the high to the open, and that means the open is important today, and therefore it's a potential magnet. So the bulls buying above 66 are not looking to scalp for 5 points. They're hoping that we go back up to the open of the day where they can make 10 or 15 points. Do we have to get back to the open of the day? Not at all, right? We're in a small pullback bear trend since 44 or so. So it's possible that there are sellers above, but this is not behaving the way bears want. They don't want it to be stalling at a target. I've been talking about the target all day. I put that target there 4 days ago. I put it there on Monday because last week's low is always important. Last week's high is important. On the daily chart, yesterday's high, yesterday's low are important. That's why I draw lines for yesterday's high and low. There's yesterday's low. Tried to get above it, tried to get above it, tried to get above it, tried to get above it. Could not hold above it, so we tried going the other way. Remember, I talked a few times today how the market's struggling to hold above the moving average. And when that's the case, the market tends to work lower. Bears are trying to get a strong breakout below the low of last week. Does it sell to close? I think it's more limit order selling the 57 high, selling the 63 high. And I think a lot of the bears will scalp. So it's not great sell to close. Now, what about buying a reversal up? Failed breakout of yesterday's low. A tight bear channel, 55. The bulls will need as good a bull bar as they can get. Otherwise, traders will wait for 2 bull bars or 3 bull bars. Is this buy the close a bear surprise and a sell climax? I would not. It's possible that this will become a stronger bear trend. I don't think so. You know, we stalled 62, 63, 64, 65 at important support. We're breaking through the support now, but the day has not had a lot of energy. That reduces the chances that we're going a lot lower. Next target is the bottom of the 2-week trading range. I don't even have that down. I got to put that down. Oh, right here. I do have it. Oh, last week's low is the bottom of the trading range, so that we're already breaking below the bottom of the range. This is a 60-minute chart. The bears want a measure move down. Good bar for the bears. They're trying to get a follow-through bar. Can this be an exhaustive sell climax? You know, it can be, but it's a big enough bear surprise, so we'll probably get at least a small second leg down, like 13, 14, or 15, 16, 17. We got at least a small second leg down. Accelerating down. So more traders selling the market. And why would you sell the market if it could be an exhaustive sell climax? Because it's a big enough bear surprise so that the first reversal up will probably fail. So traders sell the market. If it bounces 5 or 10 points, they sell more, and then they expect it to test their first sell, and they can get off break even. Should you sell here? I think most traders should wait. If they sold, they should have sold during 66 or early in 67. We're probably going to get some profit taking here. Far below the average price, but consecutive big bear bars, probably the first reversal up will be minor. If there's going to be some profit taking, and there should be, can you buy for a 5-point scalp and then sell 5 points above the close of 67? In theory, it makes sense, but I would not do it. This is a big bear breakout, and it could lead to measure move down. we have a double top. I know it doesn't look like a double top, but it's a double top. And we have a neckline here. And that target, the measured move, is within reach. I always first, whenever there's a possible double top, I always first look for a measured move based upon the lower of the two highs, which is there. And we're almost there. If it goes through that, then I look at the measured move based on the higher of the two highs. Right now we have a double top here and here. This is the lower of the two highs, and here's the low, the neckline, the lowest price between the two highs. We're almost there. Stop for the bears is far above, so if you're selling at this point, you should be trading smaller. Unlikely that we'll get back to the open of the day, so I'm going to remove that line. Can we get back above last week's low? We'll probably get above it tomorrow, if not today. Might get above it today. Whenever the market triggers a sell signal or a buy signal, in this case a sell signal, whenever the market triggers a sell signal on a higher time frame chart, it usually pulls back below the entry price. And that's true whether or not it's going to continue down or reverse up. Bears, I'd get out a tick above a bull bar closing above its high. I'd get out, maybe the bars are pretty big here, maybe get out 2, 3, or 4 points above any bar, including above a bear bar. And for the bulls, they would need a really big bull bar closing on its high to make traders buy the first reversal up. So I would not buy above 68. Smaller bar, 68, tail 68, tail 69. So some profit taking around a measured move. Are we going to get enough profit taking for bulls to be able to buy and make a reasonable profit? I would not take the first reversal up. I think there'll be more sellers than buyers on the first attempt to go up. If a trader is short, theoretically the stop now is above 64, but you're not going to risk that much. So I would get out maybe 2 or 3 or 4 points above 68. Can you buy with a limit order at the measured move target? Well, that's an interesting question. If you're a computer, you could take that buy and buy more 5 points lower, 10 points lower. The other measured move is based upon this high, 13, and the market probably will get profit taking either at the measured move based upon this high or the measured move based on that high. So they'll either get profit taking around here or maybe 4 or 5 points lower. So yeah, computers will buy here, buy the market, buy with a limit order at the measured move and buy more 5 points lower, 10 points lower, betting that we're not going to collapse from here. However, that's fine if you're a computer and you don't have feelings, but you're not a computer and you do have feelings. And the most important feeling will be fear. And when you're afraid, you're going to do stupid things. So I think it's better to not buy the market and scale in 5 points lower, 10 points lower, even though mathematically it makes sense. Can you sell the close here? Well, it's still theoretically sell the close, but this is too extreme and we're too far from the moving average. Both of those things will tend to attract profit takers. And we had profit taking here. Market rallied 10 points. We could easily get a 10-point rally here. Are you able to sell more 10 points above? Probably not. So better to wait to see if we get a low 1 or a low 2 over the next several bars. You can see the hesitation. We're at that measured move. The other measured move is based on this high and that low. And it's a little bit lower. So double top, we're at the measured move based upon the lower of the two highs. If we go down based upon the higher, it's a little bit lower, and probably some profit takers here. Profit takers, it does not mean bull trend, but it could lead to a bounce for a few bars. What's the news that caused this? Irrelevant. It's not caused by the news. It's caused by computers thinking we're failing at the moving average, and therefore maybe we'll go in the other direction. Whenever the market does something 2 or 3 times and is unable, it often then tries to do the opposite. And we were trying all day to get above the moving average, and we had a hard time getting much above it. And the bulls gave up over here, and the bears saw the bulls giving up, and the bears started to sell more aggressively. Even though 70 dipped below 69, it's still a pullback in the bull trend. And therefore, it's still theoretically a low one selling below 70, whether it has a bull body or a bear body. But we're hesitating at support, just like we hesitated 63, 64, 65. There, we ultimately broke to the downside. Here, I don't think we're going to go a lot lower. I think we might go a little lower, but probably not a lot lower. For most of the day, for the first 60 bars, it was a pretty balanced day with lots of reversals. A day like that usually does not become a big trend in either direction. So we're around the measured move. I'm not going to buy the first reversal up. Kind of like yesterday, we had a trading range and a bear breakout. Yesterday, trading range and a bear breakout. Strong enough breakout to expect at least a small second leg sideways to down. And the second leg down was 4 consecutive bear bars. That's strong enough to expect at least one more leg down. The wedge bottom was an 8-bar bear micro channel and only a doji bar, so that's probably not a very good reversal. Bears taking some profits, and some bulls buying, looking for a bounce. But I think it's better to wait for a micro double bottom or for 2 or 3 consecutive bull bars and then buy. First reversal up, probably minor. Probably sellers not too far above 69. Could be 1 tick above, could be 5 points above. Like wedge on a higher time frame. 1, pull back. 2, pause. 3. 70, a multiple of 2, so corresponds to a 10-minute bar. 10-minute chart. Parabolic wedge. 1, 2, 3. 2, and pause, and 3. Good bull bar, but very tight bear channel. So probably better not to buy the first reversal up. Bears, I'd get up above the bull bar, closing above its midpoint, 70. And for the bulls, I think you only buy that if you can use a wide stop, like 20 points, and scale in 5 points, 10 points, 15 points lower. You can see more limit order bears selling 69 high, 70 high, than stop order bulls buying. For the bears, it's a low one below 71 or below 70, but I think it's too far from the moving average. And plus, we're sideways for 3 bars here, so I would wait and not sell below 71. A lot of times when you get a sell climax, traders expect a second leg sideways to down. And usually the second leg sideways to down is only 1, 2, or 3 bars. So there's probably not much more down over the next few bars. When you get these second legs down from sell climaxes, usually there'll be buyers within 2 or 3 bars. So we're probably not going a lot lower. And then the bulls will try to get a second reversal up, like we had yesterday. Here it fell 4 bars, and then we got a second reversal. Here we got a pretty big second leg, but the first leg was not as big as today's, so there's more exhaustion today. Here we got a lot of bars down. That's more the exception when you get an extreme sell climax. This is on the open. I think you have a better chance of good follow through. Now we're late in the day and better chance of some profit takers. But this is what often happens, a sell climax, and then a brief second leg down, and then the selling stops. Here we reverse up, but I don't think we're going to get much of a reversal up today. I think the best the bulls will get is a trading range, maybe back up to there. The market's ignoring the measured move, so I'm going to remove it. It could also be a measured move based upon the entire upper range, which it looks like it is. No bottom yet. But if we do get a decent bull bar, 73 or 74, traders will buy. Bears will buy back shorts, and bulls will buy looking for a trading range, maybe a test of the sell climax high here. But they'll need a pretty good buy signal bar. If you're buying in a strong bear trend, you need to have really good buy signal bar. For the bears who get up above 70, my general rule is to sell below a bear bar. 71 was not a bear bar, or sell at a new low on a stop below 70. And you got 5 points here. You either exit with 5 points or exit at the measured move, or you exit above the bull bar, maybe 73. And for the bulls, they want a bull bar, and they prefer a big bull bar closing near its high. And can we keep going down? Can we get a third leg down? It's possible, but if we get a decent bull bar 73, it's a reasonable buy. The bulls hope that we get all the way back to last week's low, but they probably will not get that, and they'll probably be disappointed, and then they'll end up scalping out, maybe around 72 high. Most bulls are not going to buy above 73 unless it's closing on or near its high. Still sell the close, sell for any reason, but I think most traders should not sell this far down. Probably not a lot of profit potential remaining, and at a minimum, they have to risk to at least 2 or 3 points above 73. Where's the next support? Well, the 4,000 big round number, probably out of reach today. 74 low, below 73, but it's still bull bar, so it's still pulling back in a bear trend. So theoretically, it's another short below 74. But we're starting to stall. 69, 70, 71, and then 73, 74, and we're far below the moving average. I think it's better not to sell below 74. And what about buying above 74? A final flag 71, consecutive sell climaxes. The math is not great. The traders taking it are hoping that we reverse up sharply. We probably will not. So we may just go up a few points and then sideways and close near the low of the day. So not a strong buy. The bulls who buy are hoping we suddenly rally and get a big bar, a big bull bar. They know we're probably not going to get that. So the bulls who buy above 74 will be pretty quick to get out if they're disappointed, and they expect to be disappointed. Chances are we're not going to get a big rally. Chances are the best the bulls can get is sideways, a tight trading range for the remainder of the day, maybe up here. Buying in a bear trend, you need things to be perfect. 74 is not perfect, so I'm not going to buy above 74. It's okay to exit shorts above 74, but it's just not good enough to buy. And for the bears, it's a low one below 74, but we're getting bull bars 70, 71. We're getting smaller bars 68, 69, 70, 71, 73, 74. So the sell-off is losing momentum, and therefore we're probably not going a lot lower. So not a very good sell below 74, not a very good buy above 74. We may not get any more trading today. The bars are getting small, so we may start to go sideways in a tight range. Still melting away. I'm flat. I got out of shorts around 70, and I did not sell again, and I did not buy. Small parabolic wedge, 69.73. Bears, I'd get out above a bull bar. I'd get out 2 or 3 points above any bar. And bulls, I don't think there's much upside. But if there's a perfect bull bar, it's probably okay to take a chance. But I really don't think it's going to go up much, even if we get a good bull bar. It looks like it's just melting away, and the day's going to close near its low. The market is ignoring support. I'll just remove that. Do I worry about not selling this? No, I never worry about trades that I do not take. And I often miss parts of trends, and I just don't worry about it. All I worry about is the trades that I take. Did it make sense to take the trade, and did I manage it well? And just all I'm concerned about is accumulating profits. I know I'm never going to make the maximum profit. I've never traded a single day perfectly in my entire life. So, if you look at the charts that I create at the end of the day, I have a lot of reasonable buy and sell signals on the charts. And I've often taken many of the trades over a short period of time, 2 or 3 hours, but I've never once taken every trade for an entire day. And it's just not, I just don't have that ability. You get phone calls, your kids call, you got to go to the bathroom, you got to eat some food. Stuff happens, and it's very difficult to catch every possible trade. Sometimes I'm lucky, I can catch every trade for 2 or 3 hours, but usually it's more in spurts. I'll catch several trades or hold a trade for an hour or two, and then not take some trades over the next hour or two, especially when the market looks like this. I usually stop trading and wait. Who's buying? Is it mostly bulls betting we'll get a big reversal up from a parabolic bottom, or is it bears taking profits at the end of the day? It's probably mostly bears taking profits. How do I know that it's mostly bears taking profits? Well, 2 reasons. One is it makes sense. There's not a lot of profit potential for the bulls, so not a lot of bulls buying. And for the bears, they see the parabolic wedge, where at the end of the day, they have very big profits. They don't want to hold overnight, so they'll take some profits. The breakout, 66, 67, it broke out of 63. And sometimes you'll get a measured move down when you see a breakout. But today we fell more than that. So here's the breakout point, 63. And there's the high. And we're a little bit more than that measured move. Not good enough to get long, and reasonable to exit shorts at the market or above 77. What happens if it races up over the next 2 or 3 bars? It's unlikely. I don't want to take a low probability trade, even though there's a big reward potential. So I'm not going to take any more trades until tomorrow. Big announcement tomorrow, CPI, the inflation report. and then again on Wednesday, FOMC. It was a quiet day for the first half of the day, par 44, and then we had that sell-off, still a possible trading range day. And I think the day really changed on 66, 67. We broke below the bottom of a 8-day, 9-day trading range, last week's low, and we had consecutive big bear bars closing near their lows. That increases the chances that we'll get at least a second leg down. And the bulls were unable to get a reversal 74 after the second leg down. They were unable to get a reversal after 77, the third leg down, and traders just sold into the close. I think there are several interesting things going on. Let me start with the monthly chart. We were above the 20-month moving average for more than 20 months. So traders have been willing to pay an above average price, and now they're finally getting an opportunity to buy at the average price. That reduces the chances that will go a lot lower. Also, this is a tight channel with a lot of bars in it. That reduces the chances that we'll enter a bear trend. But the current sell-off is big enough so that it could be the start of a trading range that could last a year or two. We were sideways here for a couple of years, even though we were in a big bull trend. Weekly chart, we had 7 consecutive bear bars, so that's unsustainable. Unsustainable means climactic, and climaxes usually lead to a couple legs sideways to up. We had one leg up 2 weeks ago, and the bulls are hoping we get a second leg up next week, and I don't know that we will. For the bears, we broke below a year-long trading range, and it's a low one sell. They're hoping that this is a spike, pull back, and we just channel down for the next many months and go back below the pandemic, the pre-pandemic high, the high before the pandemic, around 3,300. As I said, I don't think we'll get that low. I've been saying we probably bottom between 37 and 39. And we may go a little bit lower. This is so strongly bearish, but I know right now maybe a 30% chance we'll get down to the pre-pandemic high before we try to get back up here. On this chart, when I look at this, I think we're probably going to get a second leg sideways to up. This is the weekly chart rather than continuation down. This is so climactic. Daily chart, since the start of the year, that's the all-time high. We've had several strong rallies, and every one of them failed. Every one of them led to a new low, and the bears are hoping this will be another example. And it might be, but we're at support on the monthly chart, and we're down to where I thought the market might go, 20% down from the high, and we closed the gap on the monthly chart above the March 2021 high. This is a good bear bar closing on its low, breaking below the trading range, and the bears are hoping that we're doing this, that we're doing this, that we're resuming down, that we're doing this, and we might. Follow through is important. If tomorrow is another bear day closing near its low, it will increase the chances that the May low will not be the final low. It will increase the chances that we're going below the May low. However, if tomorrow is a bull bar, then this could be a bear trap, and we could form a higher low and get another leg up. 5-minute chart, we spent half the day yesterday going sideways, and today we spent half the day going sideways and trend resumption down. On the open, we had a big bull bar 1, a possible final flag reversal. Yesterday's trading range could be a final bear flag. But I said there were 2 problems with it. One is it's right below the moving average resistance in a bear trend. So there's not much profit potential. And also the probability is not all that good. Then the other is the bar is really big. And so a trader buying above 1 puts a stop below 1. That's a lot of risk, and a lot of traders don't want to risk that much. So not great risk reward, not great probability. Why buy above 1? You have to have some reason to buy. You either need good risk reward or you need good probability. And this has neither, and therefore there probably are more limit order bears selling above 1 than stop order bulls buying above 1. And bar 2 is the exact opposite. How much lower are we going to go immediately after the big bull bar 1? Probably not much. So there's probably not much reward, not much probability of much reward. And the risk is big. If you sell below 2, your stop is above 2, you're risking, I don't know, 12 points, 15 points. And that's a big risk. So you get bad risk reward and bad probability for stop entry traders. And that means it's probably good for limit order traders, buying the 2 low or buying the 1 low, or wait for a reversal up to buy. 3, a lower low double bottom, 1, a second reversal up, with consecutive bear bars, 1 being big and closing near its low. It's probably sell the close, but I would not sell near the low. And for the bulls, it's a high 2, but I don't want to buy above bear bar 3. 4, we have a bull bar closing above 3, good, but it has a big tail on top, so I don't want to buy above. We reverse down on 2, reverse up on 4. After bar 1, we had 2 reversals. This is probably a trading range open, which means expect reversals and expect limit order trading. Broke above the moving average 5. Bull follow through closing on its high 6, but near the top of yesterday's trading range and not far above the moving average. And resistance above at yesterday's trading range high 74 and at the 60-minute moving average. Plus tail 4, tail 5. So, and trading range open. So I don't want to buy above 6. It's a strong enough rally so that we'll probably get a higher low and a second leg sideways to up. So there's not a lot of profit potential for the bears, but we should test the 3 high. Why? Because it's a bad buy setup. We have consecutive bear bars 2, 3, 1 being big, closing near its high. Probably bears will sell the 3 high and sell more 5, 10, 15 points higher, expecting it to get back to the 3 high. So probably we're going down to the 3 high. But the bears who sold the 3 high will be disappointed. 4, 5, 6. They're going to buy back their shorts around that 3 high. The bulls know that, and the bulls are going to get long around the 3 high. And that's what happens. So consecutive big bear bar 7, 8, but then reversal 9. For the bulls, it's a higher low. Higher low means a trend reversal, but it's 3 bear bars, 2 of them big, closing near their lows. The reversal up above 9, probably minor. So not a good stop entry buy. We have a bull bar closing near its high, 12, but closing not above the moving average. We have a doji, 11, tail 10, and 3 bear bars, 7, 8, 9. I don't want to buy too high, and that's too high. The bears have a lower high, 14. You can call it a lower high double top, 10, 13, a lower high double top, 7, 13. But it's a bull bar 14. And most bears are not going to short below that, especially in the middle of a trading range open. Bear bar 15, closing near its low. You might get some bears selling, 16, second bear bar. You might get some bears selling, but there probably are buyers around the 9 low, possible double bottom, and around the 3 low. So it's still a trading range open, and you're selling in the middle of the range, either below a bull bar 14 or bars with tails 15, 16. It does not look like it's likely to collapse here. So it's probably not a very good stop entry sell. Great bear bar 17, close below 9, breakout below 9, but holding above 3. So not a great sell the close. It might be more buy the close. Remember, to this point, everything bearish traders bought. They bought the close of 2, 3, 7, 8, 15, 16, 17. They're buying closes, betting and buying more lower. And bears are doing the opposite. Anything bullish, they're selling. The close of 1, above 3, above the close of 4, 5, 6. Betting on a reversal, and everybody's taking quick profits. For the bulls, a higher low double bottom 3, a high 2, 11, a high 2, 9, but 3 bear bars and a tail. That's not going to attract a lot of buyers. For the bears, it's a pullback. Even though 18 went below 17, it's a pullback in a bear trend. The bottom of the bear trend is the 18 low. So theoretically, it's a low 1 below 18. because you're selling below a bull bar at the bottom of a trading range, a low probability trade. Might be more buyers than sellers below 18 and below 3. I don't want to sell down here. Bear breakout 19, but it could be a micro double bottom 17, 19, and the lower low double bottom 3. So this might be buy the close instead of sell the close. And for the bulls, a micro double bottom 17, 19, but a bear bar, so not a good buy. Now we're getting a reversal up. Micro double bottom 18, 20, lower low double bottom 3. Possibly a wedge, 9, 17, 20. It's probably going to be a minor reversal. It's an 8-bar bear microchannel, so the first reversal up is probably not going to go straight up. At a minimum, I get out of shorts. You could buy, especially if you use a wide stop, but it's probably better to wait for a second buy. Bulls, a weak, a small buy signal, or buy entry bar 21. And that follows through 22. So the high one, about 22, I would not take it. And for the bears, it's on a lower high double top 21. It's a double top 18. But 3 of the past 4 bars are bull bars, and we're at the bottom of a trading range open. So I don't want to sell below 23. Probably buyers below 23. 25, double bottom 22, but a doji right below the moving average. Not a very good buy. 27, a breakout above the moving average. Well, is it all that different from 5 and 14? It has a big tail, not a very big body. I need to see at least one more big bull bar before I buy closes. Might be sell the close like 5, 6, and 14. And it was. We got a 2-bar reversal, 27, 28. Probably we'll get at least a little bit lower. But tight trading range 18 at the bottom of a trading range day. If we do not collapse on 29, bears will be disappointed and they'll buy back their shorts. It's a credible short. Stop above 27, but we're low in the trading range day, so it's not a very good short. A lot of the bears, if they sold below 28 and they see 29, they'll get out above 29. And for the bulls, a small expanding triangle, 22, 25, 29. But right below the moving average, a small bull bar after a big bear bar, after a bull trap, probably sellers above. I would not take the buy. For the bears, a pullback, a low 1. For the bears, 28 is the start of a leg down, and 31 is a low 1 sell, and what the bears hope will be a bear trend. I think it's an okay short. It's a bear bar closing near slow, closing below the moving average. We keep failing at the moving average, but we're near the bottom of a trading range day. And this is a 13-bar tight trading range, so it's not high probability. If the bears are disappointed, they'll be pretty quick to get out. Okay, entry bar, not great. Follow through, not so good. Close above the midpoint, possible expanding triangle, 22, 25, 29, 31, possible higher low major trend reversal. I'm not going to buy above 33. It's 3 bear bars right below the moving average. But the bears who sold below 31 wanted a collapse below 20. They're not getting it. So they'll be quick to get out. 34, a high 2, 29, higher low double bottom 30, a higher low major trend reversal. But a small body and 3 bear bars in the middle of a tight trading range right below the moving average. You can buy for a swing, but a lot of traders will wait to see if we break strongly above the moving average and then buy. 36, we're breaking above the moving average. We have 3 consecutive bull bars, but is it different from 27, 14, 5, and 6? Not yet. The bulls need to do more. 37, another bull bar, 4 consecutive bull bars. It's possible that this will be a small pullback bull trend, and we'll get up to the high of the day and the 60-minute moving average. But it's really not all that strong. Look at the past 15 bars. We're high up in a tight trading range. So not very good by the close. Same at 38. Bull breakout at 39, close above 38, but not all that big. For the bears, 40, double top, 27, but 6 bull bars. I would not take the short. And for the bulls, 40, a high 1 in a bull trend. But the bars are all small, prominent tails. top of a tight trading range since 18. I don't want to buy above 40. So bulls, if they're long, I'd get out below 40, and I would not buy above 41. And for the bears, it's not good enough to short. Outside down, 41, but not all that big, and close just above the moving average. I'm not going to take the sell. Then now we have outside up after outside down, so it's an OO breakout mode. But 50% of the time, you get breakout mode and it fails. It breaks out below, reverses up, breaks out above, reverses down. We're at the top of the tight trading range, 18, not far from the moving average. I would like to see a pretty good bull breakout above 42. And instead, we got a doji. 3 dojis. Possible failed breakout above the OO. Higher high double top 27, lower high double top 13, but a whole bunch of dojis in the tight trading range. I'd like to sell below a bear bar closing near its low, not 45, not 46. 47, bear bar closing near its low below the moving average. You might get some sellers there betting we'll get to the bottom of the range. And 48, consecutive bear bars, but not all that big, so it's not going to attract a lot of sellers. 3 bear bars, 49. We got 3 closes below the moving average, 3 consecutive bear bars, but not all that big and not closing on their lows. So it's possible that this is the start of a trend down, but I think it's probably a leg in the trading range, so it's not a high probability sell. And I would not buy above 49. 50, a higher low double bottom, 33, but what do we have? 7 bars without a bull body, or 6 bars without a bull body. I'm not going to buy above 50. Bears, they can get out 2 or 3 points above 50, but bulls I would not buy. Micro double bottom, 52, 50. Double bottom, 33. Close on the high. That is a better buy, but the bulls need to reverse these bear bars and break above the moving average. Otherwise, this is just going to be a pullback. 54, a breakout, a good sized bull bar, but closing barely above the moving average. And it follows 6 bear bars. I don't think it's good enough for buy the close. It's probably a minor reversal or about a 50% pullback. And again, what happened at the moving average when we had bull bars today? 5 and 6 and 12 and 14 and 27. 36 did not go much higher. 42 did not go much higher. So this is not big enough and closing far enough above the moving average for me to buy the close. So I'll wait. 55, outside down, a 2-bar reversal. It's possible that this is a reversal down from a bull trap at the moving average. I think you could sell it and take a chance that will go lower. If you want, you can wait 2 or 3 bars and see what we get. For the bears who sold, 56, disappointment. I would not get out above 56. I'd get out above 54. And bulls, I would not buy. The bulls are hoping 55 is a pullback from 54. But it looks like a bull trap and a reversal down, so I don't want to buy the first reversal up 56. 57, a micro double bottom, a bull bar, but just below the moving average, which has been resistance all day. It's still on the short, below 55. You could get out either above 57 and then sell again below 58 or 59, or just keep the stop above 54. 58, a low one. The bears are hoping 55 is a resumption of the bear trend, and 58 is a pullback, but it's 3 sideways small bars, not a really good looking sell. Bigger bear bar 58, so we may be accelerating down. We should get below last week's low, so you could sell the close, put a stop above 58 or 57, excuse me, 58 or 59. Bull bar 60, wedge 42, 51. Lower low, major trend reversal 20, bigger wedge, so nested wedge, bigger wedge 3, 20, but fairly conspicuous tail. Reasonable to exit shorts above 60, but I would not get long. And instead, we went below 60. a buy signal bar. Instead of going above it, we went below it. And so it's like a low one pullback in a bear trend. Traders could sell below 61. I'm not sure we're going a lot below the low of last week, but I do think we're going below it. 63, we're one tick above last week's low, trying to reverse, but 3 bear bars and a 6-bar bear market channel should be sellers above. I would not buy. 64, a low one, but a bull bar, not a great short. 65, a doji bar, 3 dojis, not a great short. If bears get out above 63, which would not be a very good thing to do, and the trading always in, they either sell below a bear bar closing below its midpoint, 65 did not close below its midpoint, or they sell at a new low below 63, or they wait for the breakout and then sell below the breakout bar, 66. The surprisingly big bear bar, a very good looking bear bar, so maybe we'll go down for a measured move based upon this double top or the entire day's range. And then 67, now we have consecutive big bear bars closing near their lows. It's probably going to lead to some kind of a measured move down. It could be an exhaustive sell climax. It's enough of a bear surprise. At a minimum, we should get at least one more leg down. So the selling market sell for any reason. 70, trying to reverse up, but that's enough selling. 66, 67. We should get a second leg down. So sellers above 68. If you get out above 70, you sell again, either below a bear bar or at a new low below 69, which is a bear bar. So you can sell below 69 because it's the current low and because it's a bear bar closing near its low. Plunged 72. It's possible that this is a second leg down and that we reverse up 73, but it's still sell to close. 73, bear follow through. 74, the bulls are hoping it's a second leg down and the low of the day. They can get out above 74 and sell again below a bear bar or below 73, but I would not buy. I would either be short or flat. Another leg down, possibly a third leg down, but no reason to buy. Traders are only selling. And we plunged all the way into the close. Limit order traders, I think it's really difficult. For most traders, I would not. Most traders should not. I would, but most traders should not sell above 1 or buy below 2, and they should not do that. You have to use wide stops. You have to scale in. Not worth it. The first reasonable limit order buy, could you buy the 6 low? Probably. And if you bought more 5 or 10 points lower, you'd get out on 13 once you're back to that 6 low. Probably sellers above 9. And here, might be buyers below a bull bar 23. Here, probably buyers below 40, but you're high in the range and it's a bear bar. Here, probably sellers above 52. First leg up is probably minor, and sellers above 63. Early on, they sold new highs above 2, above 27. They bought new lows below 1, below 3. But once we had 66, 67, the day changed. Once you have consecutive big bear bars closing on their lows with very little overlap, you're probably going to go down for some kind of a measured move. And we went more than down for a measured move. Question was today caused by bottom picking bulls giving up? I think it's caused by disappointed bulls on the daily chart. They were hoping that we would get a second leg up, and they were not getting it. So a lot of them gave up, disappointed, especially going into tomorrow's CPI report and next Wednesday's FOMC announcement. They're afraid to be holding. They wanted the second leg up. They're not getting it. So I think a lot of it is disappointed bulls, concerned that we're not getting the second leg up. And if you're talking about the 5-minute chart, these two bars, 66, 67, changed the character of the day. it increased the chances we were going to fall for a measured move. And that's both bulls giving up and bears shorting. Question: to reverse a strong bear trend such as later today, is a micro double bottom or double bottom across a few bars sufficient, or do we need a larger pattern across many bars before looking to buy? Could 52 or 63 be a major trend reversal? Probably not. The smaller the pattern, the more likely it is to be minor and last just a few bars or only retrace maybe half. And the bigger the pattern, you have a 40%. If you have a bigger reversal pattern, a big double bottom, a big wedge, you'll have a 40% chance of a trend reversal into a bull trend. If you have a minor reversal pattern like 52, there's a 30% chance it'll reverse into a big bull trend, but 70% chance it'll either be a bear flag or a trading range. In general, the smaller the pattern, the smaller the bars, the smaller the number of bars, the less likely it's going to lead to a big reversal, a major reversal. Okay, what are the best two entries today? I think there are two. I think above 34 is reasonable, not great. And I think selling the close of 67 or below 67, 68, betting on some kind of a measured move down. But it's hard to take. When you see a quiet day, and now we're suddenly breaking out strongly with follow through and bigger bars, the stop is far above. It's hard to take. In general, if you see something that you think you should be taking, but you're not taking because you're afraid you have to risk too much, you should have a default second size position, a much smaller position, and I don't care size position. I usually say 20% what your usual position is, and then sell that, and then sell more as it goes down. I'm personally hoping that we have not seen the final low. I'd like the market to go down further. And I talk about garbage stocks. On television, they don't call them garbage stocks. They call them value stocks. And probably the best representation of it is Kathy Woods' ETF, the ARK fund. She has a whole bunch of stocks in her fund. This is the daily chart that look like this. Bulls are hoping that this is going to be the bottom and that we accelerate up. It's still more likely we're going to get another leg down. There are a lot of stocks that look like that. Here's Square, Shopify, Snap. There are many, many charts that look like that. They all have the same pattern. And to me, it's possible it'll be a major reversal, but it's more likely we're going to go lower. So I'm hoping that we go lower, and I will probably load up on value stocks if we get another leg down and start to form some bull bars. But I'll probably trade, look for a bounce, try to make 10%, 20% over the course of a few days or a week, and then exit. All right. Hope everybody has a good night.